Let's start discussion regarding paragraph 27 of IFRS 8. Here, the primary purpose of this paragraph is to specify whether there is any measurement difference between the assets and liabilities and the profit that has been disclosed in the financial statement with the information that is provided to the CODM or between the segment reporting. So it's any measurement difference between the segment reporting and the entity's financials. So the first one is to disclose how the revenue, how the transactions has been made or being recorded between the department 1 and department 2, that is within the entity, how the profit and loss being measured, and how the assets and liabilities being measured, if there is any difference, and if there is any difference between reportable liabilities, reporting liabilities and the liabilities that's being reported in the financial statement. So this is basically comes into picture. Point number B, C, and D will come into picture when there is a difference between the recording or between the measurement basis between the entities reporting and the information that is provided to the CODM. Point number A, we need to disclose in any ways, like how do we record any transaction which is made within the entity. Fifth point will come into consideration when there is any prior period changes in the measurement, and sixth point consideration will come up when there is an allocation differences. So I've just noted an example here. An entity might allocate a depreciation expense to segment without allocating the allocating the depreciable asset to the segment. So this can be one of the example that I can explain it right now, that is if there is any allocation difference between the reportable segments of a particular item and which is not symmetrical. So these 4 points we will talk into, and we will see how the disclosure is done. The first thing, 8 point, this is note number 7 and serial number 7. Perfect. Now there are varying levels of integration between forestry and timber product segments and the standard papers and recycled paper segments. So these are basically two segments. This integration includes transfer of raw material and distribution services respectively, and the pricing determined on the arm's length basis. So this is a measurement of transaction the between the entities transactions. Now point number 2 is any measurement difference between the profit and loss items. Here, the performance of the joint venture is used as a proportionate basis of consolidation rather than the equity method. So this is point number 2. And the segment performance is evaluated based on the profit and loss and is measured consistently in accordance with the consolidated financial statement. Point number 3, for the assets and liability assets, investment in share apart from this are held by are not considered to be segment asset but are managed by the treasury functions. Segment assets are valued in the same way in the financial statements, and these are allocated on physical location basis. And how the allocation is done. Segment liabilities, also these liabilities are allocated based on the operations of the segments and measured in the same way. Borrowings are not considered to be segment liability. These are managed by treasury functions. So these two treasury functions items, they are not allocated to any particular segment, and they are shown as an other segment item of the entity, and they form part of the reconciliation that we're going to discuss. So all these 5-6 points under the paragraph 27 we have discussed till now. In the next subsequent video we will watch and see other disclosures. Thank you.